Hello and welcome to our latest investment update as of July 31st, 2020. I'm Mark McCarron, Wescott's Chief Investment Officer. And in today's edition, we're going to give a quick update through July 31st on the global markets. We're also going to talk a little bit more about the signs of the economic growth that we're seeing developing across the world, which is good news for future growth and future stock market performance. And then finally, our outlook as of today. So quick update on the market. First, while the markets are doing very well and looking forward, the numbers today, the US GDP numbers came out and indicated the depth of the slowdown in the second quarter. US GDP fell 9.5%, which equates to about a 32% decline on an annual basis, which is historically one of the worst periods ever. However, the markets are not looking at that history. In fact, economists expect the third quarter of this year to show growth as the economies continue to reopen. Another issue that the markets are dealing with this week is that expanded unemployment benefits, which included a $600 per week payment to the unemployed, are set to expire today. And one of the real challenges to this continued recovery is that fiscal support we're getting from Congress and the White House. And in fact, congressional leaders in the White House continue to negotiate today an economic stimulus extension, which the market is anticipating. But what we see is while cases continue to rise across the world, there has been progress on vaccine development, and in particular, drug trials that have been announced recently. And that continues to support and provide some hope for a return to normal. So a quick update on the virus. So the last couple of weeks of July, there's been some evidence of weakness in employment figures and also consumer spending. However, and that's really because of the second wave of cases. So if you look at this chart, this is from Johns Hopkins Coronavirus Resource Center as of yesterday. And what we're showing is the daily confirmed new cases, a 5-day moving average. And it's really for the top 10 most affected countries. And unfortunately, the US is the most affected country. And we did see some improvement in April and May as some of the initial lockdown measures were applied. But as economies and states started to open, what we saw was a spike in daily cases up to about 70,000 per day. The good news, I think, is that that trend, that second wave, if you will, seems to be abating, and daily confirmed cases in the US may in fact peaked. And as this infection rate declines, states can begin to reopen again more fully. And that's really what's driving economists' expectations that the activity expected in the third quarter should be positive. So with that as a background, we want to take a look at the market. The performance in July continues to be positive. The S&P 500 effectively has erased all losses for the year. It's up 1.5% year to date through yesterday. And I wanted to highlight a couple things that the technology sector, the strength in that sector is pretty evident when you look at the earnings announcements that are coming out this week from industry giants such as Amazon and Apple. In fact, the tech giants seemingly were unaffected by their congressional hearings this past week. And what we're showing on the chart among the S&P 500, which is this light blue line, the bond market, which is that orange line, but we're also looking at the technology-heavy NASDAQ index, the NASDAQ QQQ, which is up 23% this year, which is really amazing compared to the rest of the market. And as a reminder, Wescott added more exposure to this position back in March, really in the depth of the crisis, as concerns were rampant and driving all companies' stock prices down, even those good quality ones. And clearly there's been a recovery, which has been led by this technology sector. But that's not the only thing that's improving. If you look at the non-US markets, they continue their recovery. That's the gray line. While they're still minus 5.7% off where they started the year, we've had a strong July for both the developed markets, which is represented by the MSCI EFA index, which is up 3.8% so far this quarter, and the emerging markets, which is at a really strong 9.3% return so far this quarter. And we're going to talk a little bit more about why that is in the next slide. Finally, the US bond markets remain very steady and a good source of stability in client portfolios. The bond market it will continue to be stable, but fiscal deficits will continue to grow. And in our view, the markets aren't really focused on the costs associated with increasing debt levels in the US. And it's something that we're aware of, the market's aware of, but not in the short term. This seems to be a longer term concern, but not necessarily reflected in the markets today. One comment on that is that we maintain a fairly conservative approach to the bond market and a shorter maturity emphasis, which we think is the appropriate approach given the concerns over long term in terms of increasing debt levels in the US. So what we are seeing in the emerging markets so far in July, in the global ex-US markets so far this quarter, has really been a positive, and it's been really, I think, in anticipation of a recovery of the global economy. And one of the things that we look at very carefully is how the US dollar trades relative to other currencies. So that's a bellwether, that's a market indicator. And typically the US dollar, when it weakens, it tends to happen when global growth improves, which is what we're seeing right now. So on the right-hand side, we're showing a chart of the US dollar index against major currencies. And when that chart is rising, the dollar is getting more expensive or appreciating versus those currencies. And when it's falling, like it has so far in July, it's depreciating against those currencies. So one comment I would make is that the dollar is very expensive relative to its history. And that is an important factor when traders think about buying more US dollars. They think about the price relative to other currencies. As it's falling, though, it's depreciating against those currencies. And that's a positive thing because typically when that happens, cyclical sectors such as industrials, energy, and materials, they tend to do better. And non-US markets, and in particular emerging markets, tend to be more cyclical in nature. That's the makeup of their economies. More financials, industrials, energy, and materials. And that's why we're seeing, I think, a positive return in the emerging markets so far in July. The commodity sectors are improving and getting better as more demand for materials picks up. And that's also a positive for small companies as well, which tend to be a little bit more economically sensitive. So we're going to continue to monitor and watch how the US dollar trades against all these major currencies. But what we're seeing is the beginning of a weakening cycle potentially, and that should be supportive of non-US markets, emerging markets, and in particular small companies. So with that, just a reminder of our current outlook. If the daily case counts in the US do in fact level off or even decline from here, we would expect economic activity to recover, although we continue to see it recover in an uneven way, which is important to maintain, in our view, a balanced portfolio. A rebound in economic growth may support recovery in these cyclical sectors, as we talked about, small cap in particular, and non-US markets. And as we just mentioned, we're beginning to see evidence of that in the currency markets. As we mentioned the last couple of times, the upcoming US presidential election will likely be a source of uncertainty and could lead to some market volatility as we approach November. And that's, again, important why we have a balanced portfolio and high quality in our portfolios for clients. And then we briefly highlighted this, but increasing the US government debt as a result of perhaps lower taxes and also more spending and fiscal stimulus. It's not a focus of today's markets, but it could impact long-term, what they call trend growth, how fast the US growth could be in the future. It could also increase inflation and potentially lead to bond market weakness. We haven't seen that yet, but when it does, we think that our shorter term, more high quality positioning in the bond strategy is well supported. So that's our current outlook. That's a quick update on the markets. As usual, we thank you for joining us and your continued trust. Please don't hesitate to reach out to me or your advisor with any questions. Thank you.